My name is Aravind. I was a former private equity associate, and last year I left to go and pursue the world or life of entrepreneurship. So hopefully, whether you're interested in the world of finance or you're interested in starting a business one day, you'll learn something from this talk that I give. And hopefully, well, the main things I want to cover today are a little bit about my journey, but I don't really want to bore you on too much. But then I'll try to give you a little bit of insight into kind of the practicalities or realities of working in private equity, and then also what my experiences have been so far launching a business and things that hopefully you guys can take away so that you can even have a better start than I've currently had. I'll give you a very, very quick introduction about myself. As I mentioned, former private equity associate. So I was at for 3 years. So I did 2 as an analyst, and then I did 1 year as an associate. A little bit about me. I got there the hard way. So I didn't get any spring weeks in my first year. Really had to work my way in my second year to recover, and ultimately ended up landing internship offers for private equity, investment banking, and strategy consulting. I previously studied at London School of Economics, graduated with first-class honours, and now I went and founded ASURE. Next slide. So I think that's like the high-level details, but I think it's also worth going one level or layer deeper, just to kind of explain a little bit more about the intricacies of this, right? So prior to going to LSE, as a sixth former, I think like a lot of people in this room, was focused very much on academics. So I got 15 A stars at GCSE, 4 A stars at A level, and I also managed to get a decent amount of relatively relevant work experience for the finance sector. Now, I don't say that to kind of boast. It will become relevant in pretty much 2 seconds. And I ended up going to study economics at LSE for broadly 3 reasons. The first was that I thought that I enjoyed studying economics at A level. I didn't think I was all that great or not particularly exceptional at anything else. And also I'd heard that economics was like a surefire way. Economics at a target university was a surefire way to break into finance, which paid well, right? It's only now that I kind of realized that I kind of did econ for all the wrong reasons, because any of you who are taking econ right now probably know that it's completely different at university than it is at A level. And I guess also, I also didn't actually know what investment banking properly was. I just heard 6 figures and that was it. Had I spent a bit more time researching, I might have considered more options, right? So fast forward a little bit to first year of university, and I was a bit of a naive 18-year-old and was under the assumption that, okay, I've got a pretty good academic record, I've got a decent amount of work experience, and school had told me that my CV had looked pretty good when I asked them about it. So on that basis, I started applying to spring weeks. I kind of knew what they were, didn't really appreciate just how difficult they were to get one. So I kind of naively applied, let's say, right? And made all the rookie errors, applied with a 3-page CV. My cover letters weren't tailored. I pretty much winged all my hire views. I did them after dinner or whatever, whenever I had a couple, spare 20 minutes or whatever, right? And I suffered the consequence. I got 0 spring weeks. And then it was my second year and beyond. So at the end of my first year was when COVID hit. So thankfully I had a lot of spare time to actually go and research the industry. And I also kind of got a bit lucky because so many spring weeks got cancelled, but it leveled the playing field a little bit. So I kind of benefited through a few things that meant that I could spend time to understand the industry properly. I spoke to the right people and thankfully managed to rectify things, turn things around and land a bunch of offers. I applied to 30 places, got 3 offers, as I mentioned before. And then after I did the internship, really enjoyed the internship, got a grad offer, and then in my final year, I basically dedicated it entirely towards helping people, students like yourselves, trying to break in if they also aspired to get into finance. I think a lot of people are curious about what the world of private equity is like. I think going into university, at best, you've probably heard of investment banking, and even then, you probably don't fully understand what it is. And so private equity and hedge funds and venture capital, and you get thrown with all of these other different terms, that are quite, can be a bit daunting if you're not familiar. So I thought it would be good to allocate a bit of time to explain what infrastructure private equity is and what my experiences there were like. So first of all, next slide, please. Yeah, so first things first, let me just talk through what private equity is as a concept, and then we'll look at what infrastructure private equity is, okay? So Next slide, please. Yeah. So the way I kind of explain private equity to people is it's kind of like buying a rundown house. Just rather than thinking of a house, just replace house with a company and you're kind of 90% there. Right? So you might have heard of people who will buy kind of really old houses that need a lot of work doing to them. They'll buy it, they might put a mortgage to buy it, and then they'll spend maybe a year, like a couple of months to a year doing it up again. Eventually they'll decide to rent it out on the market for, let's say, 5-6 years. And after a while they go, actually, I think I want to make another investment. I'm going to sell the house. And when they sell the house, they look to sell it for more money than they bought it for. At its core, that is basically what private equity does. A little bit more technically, private equity is like a kind of investment where a private equity company will take money from a bunch of different investors. So most normally it's things like pension funds, insurance companies, and sovereign wealth funds, but you also get things like high net worth individuals, so rich people basically, also sometimes contribute. And effectively, these outside investors are known as LPs. And then you've got a private equity company who's basically managing their money. And they're called the GP, the general partner. So the LPs provide cash, and the private equity fund manager effectively provides a little bit of cash just to put the skin in the game and make sure that incentives are aligned. But their main role is to just manage that money. And that money is pooled into what is called a private equity fund. And then from that fund, you invest into private companies and you develop what is called an investment portfolio. By private companies, I mean companies that you and I can't buy on the stock exchange or via an app, right? They are in private ownership. Once you buy one, or once you kind of acquire one of these companies, broadly, the investment that you make goes through like a 3-stage life cycle. So the first thing, before you even buy actually, is you need to have a good rationale as to why you think this is going to be a good investment. So normally you think it's because the company operates in an industry that is well positioned to grow, or you think that that company in and of itself has something unique about it that makes it positioned to grow, right? So you buy it on that basis, and normally you're competing with a bunch of different private equity companies to buy the same business, but hopefully you're lucky and you're the one who gets it right and pays the right price for it, right? The next thing you do is, okay, once you've bought it, you have this big plan in mind, but it's all well and good having a plan, but you actually need to go and execute on it. And so you will execute that investment thesis. So if you said, okay, we think that this business is run super inefficiently, we think there's like 5 different ways to make it more efficient and therefore grow its profit. That's kind of what you'll be spending your time doing. And then eventually, once the kind of company has become a bit more established or you fix those things, you might start distributing the profit from that company back to your original outside investors, LPs, right? So that's kind of the same thing, I guess, as okay, you spend a little bit of time doing up a house, and then eventually you'll start renting it out and that's your profit. It's the kind of same sort of concept. And eventually, each private equity fund will have a mandated lifetime, let's say, right? So they'll basically say, we're going to make these investments for up to 10 years, and after 10 years, the outside investors get their money back. So at that 10-year mark, let's say, they'll sell a story. So they have to try and market this company that they've previously bought and explain to other investors why this company is now worth buying. So you'll spend a bit of time developing that story, making sure that everything internally is fine with the company so that you can maximize the value you get at sale. So I guess in housing terms, that's like painting the house, making sure you've done the little bits of maintenance work before you prep it for sale. And then you'll sell it, get all your money and proceeds, and then give it back to the investors. The only thing, I guess, that's not in this slide is how does the private equity company itself make money? Why are they doing this? So of the money that the outside investors give, they will take a small percentage, normally around 2%, of the money that they give just as default, just for managing the money. So that's what's called a management fee. And then again, to align everyone's incentives, they will basically take normally around 20% of the excess return that they generate above a certain threshold. So let's say the private equity company to its investors say, we're going to target a 10% return, right? Then in reality, if they deliver a 15% return, of the 5% excess, they will take 20% of that. So what's that, 1%, right? That's kind of what they do. And actually, in a lot of cases, that's what makes the real big amount of money for the private equity fund, because it's a competitive market, right? So ultimately, there's loads of private equity companies around. So if I'm an outside investor and I'm giving money, and one company is like saying, I'm going to take 20% of everything above 8%, whereas another one's saying it's 20% above 10%, and they're both equally reputable firms, then I, as an outside investor, am going to go with the 10% one, because if they're going to do the same exact job, I might as well keep more of my money to myself before I give it away, right? So kind of the 2% and 20% fee structure is broadly what the industry kind of has settled on as a bit of a standard, but it does vary from firm to firm. There are exceptions and things like that. And then what that actual kind of threshold value itself is depends on the type of investment thesis that the private equity fund has, which I'll come to in a second. Infrastructure private equity is just a subset of private equity where you're investing into infrastructure, i.e. the assets that you and I have to use every single day for like kind of standard day-to-day running of our society and civilization, right? But some examples of like infrastructure sectors would be things like utilities, mobility, digital, and then recently people are exploring like even more things that might be considered infrastructure, like social and diverse infrastructure as well. I worked in the digital infrastructure team. So I was primarily looking at buying up and improving things like data centers, which are super relevant right now, you might have heard, right, to kind of fuel the AI boom, but also things like fiber networks and mobile towers and things like that. Now, you can invest in infrastructure, you can invest in real estate, you can invest in like software companies. So what is it that makes infrastructure particularly attractive? It's broadly these three things, right, up here. Let's go through it one by one. So because you and I have to use infrastructure every single day, it's normally very resilient to economic downturns because let's say it's the tube, right? Let's say someone privately owned the tube. Whether we're going through a recession or we're going through an economic boom, people are kind of going to have to use the tube to get to work, right? So broadly, you know that the demand for the service is going to be relatively stable. So that's number one, right? Number two is that you're very unlikely to get dislodged by competition. So you might have seen something where if you look at like the top 10 companies on the S&P 500 back in 2000 versus like today, they're a completely different set of companies because like technology shifted and things like that. The chances of something like that happening are very, very slim when you invest in infrastructure, because normally infrastructure investments are what you call sometimes like natural monopolies. It doesn't really make sense for people to replicate the same thing. So to use the example of like the tube, right? Once you've built the tube, there is pretty much no reason for some other company to say, hey, we're also going to make an equivalent form of the tube because one already exists. So as a result, it's really difficult for like rival competitors once you own like an infrastructure asset to like replicate and do the same thing in that same space. And then finally, infrastructure, I guess because of 1 and 2, end up having like quite long-term contracts, and often there are like inflation linkages within your contract, which means that you are much more, firstly, you have stability. You don't have to worry about, oh, will I lose a customer tomorrow? Whereas that obviously is a big deal for other industries. So you might have seen that Netflix a few years ago were like really like losing customers really, really, really quickly, or they weren't growing as much. Again, you don't tend to have those sorts of problems with infrastructure. And because it's inflation hedged, it means that you can deliver what is called a real return. So how I assume most people here understand the difference between real and nominal, right? So if you're targeting, just for those of you who don't, let's say if you're targeting, it's all due to inflation, right? Like obviously, like a pound today is not worth a pound in 5 years' time, and therefore you have to adjust your return to reflect for that, because the value of someone's money that they invest in today is different to the value that they would invest in 5 years' time. So you have to adjust for that. Because you've got the inflation linkages within contracts, you kind of mitigate for that by default. And so that's one less risk factor. Next slide, please. I'll very quickly go in terms of, let me go here, right? So this is broadly where infrastructure lies within the risk-return spectrum. Because it's got some of those kind of stabilistic characteristics, you might not necessarily get as good of a return as investing in pure play equities, right? Or like just investing into Google or just investing into Nvidia, for example. But because you've got more risk and there is more operational stuff to do, you will, in general, return more than like a loan or a bond or something. So people infrastructure because it's a bit of a sweet spot, and it kind of it appeals to like a certain audience who still want to get relatively good returns while still being kind of risk averse. And I've told you kind of the upsides of infrastructure. Let me just talk about the downsides or the risks. Often, as you can imagine, running something like the tube, or let's say it's like a data center or a mobile tower, they are quite technically complex assets to run. So that's kind of, I guess, the most obvious thing to me. But also because they are natural monopolies, there's a lot of regulation, there's a lot of political element to this. You might have heard that in like private equity is getting a lot of scrutiny right now, like I guess in the media and things. That's kind of where that comes from. And then also, actually, it might again be good to refer to this. So brownfield infrastructure here refers to infrastructure that's kind of already built. It's in the ground. There's not much work for you to do. It's already well established. Greenfield infrastructure is stuff that you need to construct from scratch. So imagine you're constructing brand new renewable energy plant or like a brand new toll road or something. There you've now suddenly got to take on the risk of actually constructing and building something with no guarantee that it will go to plan or it will go to cost or whatever. So because you're taking on that additional risk, normally that comes with additional return, but it is a risk nonetheless. Let me now tell you what it's like to actually work in private equity. And I guess most relevant for some of you in this room is what is interning in private equity like. Let me just preface this actually. So normally, the most common route into private equity is to do, let's say, around 2, maybe 3 years in investment banking first, and then do private equity. It's pretty uncommon for people to break into private equity straight out of university. The next immediate question people then ask me is, how did you break in? The honest answer is I didn't do anything special. There is nothing all that unique about me. It's just that one of those few companies that happened to offer it straight out of university. I just so happened to apply and got in, but there's nothing particularly unique about me. So if you do find those opportunities and you're particularly interested in doing private equity out of university, it is a possibility. It's just relatively uncommon. If you were to do an investment banking internship, you're very much kind of given, you're included as part of a team. So the investment banking division will be working on loads of live deals at the same time. If you're an intern, they will put you on those deals, they'll put you on those calls, and in most cases, they'll be getting you to do a lot of the admin work, but also a little bit of the technical financial modeling things, just so that you can like ease yourself in. In private equity, it's, at least in my experience, is a little bit different. You tend to be given like a project to do. Maybe it's like a long-term strategic thing that the firm is thinking about, but you won't necessarily be doing all that much live, actual deal-oriented work. The reason why is at an investment bank, let's say there are 20 deals running at the same time and they'll all be in different stages. Like some of them will be fairly advanced, some of them will be brand new. And so it's quite easy for an intern to get stuck in from day one. And a private equity firm, we're a lot more, you're doing a different job. Investment banking, you're doing advising, so you're working on loads of mandates at the same time, you're spreading yourself thin. Private equity, obviously, it's more about investing, so you're kind of really handpicking what deals you want to focus your time and effort and energy on, right? So as a result, you're not guaranteed that a deal is going to be in the early stages, and therefore it might not necessarily be that easy for an intern to just get thrown into it midway through summer. So as a result, if you are going to do a private equity internship, you're more so given like a project to do, and that will be the main focus of what you're doing. And then you might be given a little bit of deal work on the side. Of course, this will vary from firm to firm. So it's probably going to be someone who's done a private equity internship here who's like, no, this is completely different for me. But at least this was my personal experience, right? So my task was to firstly research a new industry that my team, so the digital team, wanted to learn about, and basically assess whether it's a good sector for infrastructure investment. So do you remember those 3 criteria I mentioned before? Like, has it got elastic demand? Has it got good, strong barriers to entry? And is it, long-term contracts and stuff? Does it meet all that criteria? If not, like, how does it get mitigated? So all of that sort of stuff. If it is a good industry, the next thing I had to do was identify a potential target that we could go and look at in that industry and defend why that target was more attractive than any other within the space. And then the final thing is actually analyze that company, produce an investment case with supporting financial analysis, and eventually the main thing that you were judged on is your presentation of that analysis to presentation of the analysis of both the industry and the company to a bunch of seniors. This is broadly, I made these as mock-ups, by the way, so nothing's confidential, I promise. But this is kind of broadly what you can expect a deck or like the main things that you output as part of your internship to look like. So you'll produce a deck, and here we're looking at industry demand and stuff, and then here's like company-specific stuff. And then you'll have a financial model to support your analysis, and you'll kind of be assessed on the quality or strength of both of them. Normally, if you're a second year going into third year, you're not expected to have really super strong financial modeling knowledge. So as long as you've broadly got the formatting right and you're broadly making sense with how you're thinking about the model, that's what they're looking for. But they will really grill you on like your understanding how deeply you've researched the company and the industry. So I got asked really like niche questions about like the regulation of the industry and how it worked and what would happen in this extreme example and things like that. And I had to confidently defend my answer. I did that internship in 2021. I obviously then went and did 3 years of actual private equity experience, and now I've left. So with kind of all of that in mind, I think my view of private equity internships have slightly changed. And so I think it's actually something that is very important for you guys to know if you're considering them. So the first thing I would say is that generally, both as an internship and I guess in the early stages of your career as well, investment banking is probably a better environment in terms of learning. And again, it's kind of due to the nature of the sort of work that you'll be doing. So as I mentioned, if you're working in the investment banking division, you'll be working on lots and lots of different deals. You'll get lots of exposure, but you'll also be focusing on doing the nitty-gritty actual financial modeling of those deals. And so you'll kind of develop the muscle memory of how to build a financial model, and you'll also get good exposure to all the different parts of how a deal works. In private equity, teams are a lot smaller, and it's a lot more about strategy, that investment thesis, and why something is a good investment. And actually, although we do financial modeling in private equity, a lot of the time it's a lot more scrappy, a lot more high level, like have you got the main drivers there and does it broadly show returns and stuff? But you're not going to do it with the same level of detail anyway, as you would do in investment banking, because that's kind of not what your job is at that point. You're like the ideas person. You'll actually hand off like the really intricate, can't say it, what's the word I'm looking for? Intricate, that's it, right. Okay, so you made it, yeah, really intricate work. Like that actually gets handed off to the investment bank to do on your behalf. So to use kind of crude language, right? The investment bankers are like the Excel monkeys doing all the really hard detailed background analysis. You're just kind of giving them the commands to do, right? So in that sense, you don't actually develop the same skills. And that was something that I really had to struggle with. I had to go out of my way to develop those skills, and I had to kind of put in the investment banking hours as a result. The second is that internships don't always accurately portray your life as an analyst. As I mentioned, in private equity, you might not necessarily be working on deals, but also there are kind of a lot of admin and logistical parts of being an analyst and associate that you don't necessarily see because, again, they can't give you that work because it's just too much context to be worthwhile, right? So you kind of get a little bit of a rosy or a little bit of a protected view of private equity because they don't necessarily expose you completely to the less glamorous parts of it. And if you work in investment banking, by the way, it might be a similar experience. Caps interns at 11 p.m., whereas in reality, you'll be working well past that if you actually end up working in investment banking. My point here is not to like put people off the industry. I just think I was in your position and kind of sold all the positives and not told any of the negatives. And I just think it's really important that you get a fair bit of both so that you make a more informed decision. The third thing, and this is one thing that I really realized only after like a few months of working, is that your mindset working full-time will be different. If you're doing an internship, you kind of, or at least I did, and a lot of people I've spoken to, think of it as like, it's 10 weeks and then I'm back at uni for my final year. And so you kind of, it's very novel to you, and you don't really consider the fact that you'll be doing this for the rest of your life. That doesn't quite sink in the same way. So you might be going, okay, yeah, I'm not sure if I'm a fan of this, but it's okay, it's only 10 weeks. And you kind of, as a result, gloss over the negatives. And I think it's really important that you, whenever you do your internship, be quite objective about the experience and whether you like it. Because it's not going to be 10 weeks, it's going to be potentially the rest of your career, right? And then finally, just know that sometimes things are out of your control. We had a couple of interns who we really liked, the team really liked, wanted to convert them into full-time roles, and then market crashed, recession, we didn't have headcount anymore. So just know that sometimes you might be a really strong fit for investment banking or private equity. I guess a lot of these points are just true of internships in general, I guess. But just know that you might be a really strong performer, and sometimes things don't go out your way because of wider macro conditions and things. And don't feel like try your best not to feel like an imposter or like really has self-doubt. Sometimes it just is beyond your control and power. Now, I've obviously talked about what life is like as an intern. Now, let me tell you kind of what life is like, or the reality of things as a full-time analyst and as an associate. So, do you remember the life cycle, like the investment life cycle I mentioned right at the beginning, like buy, execute, and sell? Your time as an analyst, or like your roles and responsibilities kind of map one-to-one with that, right? So you can kind of bucket it into three things. You'll either be working on origination, deals, or asset management, and they all kind of just interlink into one another. So when you're first starting a fund, you'll spend most of your time doing origination, trying to research industries, make sure research new industries or look for deals and things, and develop an investment thesis. Okay, these are the industries that we should be looking into, and these are the companies within those industries that we should be focusing on buying. That's kind of the first thing that you'll do. You'll prepare you'll do a lot of research, you might produce some high-level models, and then you'll look to start transitioning into execution, which then takes me on to deals, right? Deals, okay, you've done all the research that you think is that you need. Now it's time to actually go and buy these companies. So if it's an acquisition that you're working on, you'll solidify your model a little bit more, make it a little bit more detailed. You'll do financial analysis, and then there's also a bunch of documentation that you've got to work on to actually submit a legal bid to buy a company, right? There's a lot of paperwork, a lot of regulatory things that you need to do. You'll be working on that. And then let's assume you're successful. Normally, you do a lot of failed deals, and then you'll eventually get one. It took me 3 years to do one deal to secure my first deal in private equity, right? So things take a lot of time. Then once you've bought the company, you then shift onto asset management. So as I mentioned, you'll have a business plan, you'll have an investment plan or thesis in mind, and then you'll go and work really closely with management to go and execute that business plan. So I was literally flying out to Poland every month to meet the CEO, CFO of the company, attend board meetings, talk to them about like company data and like company financials. If we saw that things were like going off track, we would like talk to them about mitigation strategies and things like that. So those can be quite, you can get really quite involved and into the weeds of the business, but it's not quite as intense as working on a deal where you'll be spending the most number of hours. And the other part of asset management is
I was
yeah.
just going to ask,
Yeah.
when it comes to like on the asset management side, now you're working with the actual company, do you think that you needed to have like a level of expertise in regards to the specific industry, or were you able to just come in as an outsider to kind of see where the areas of change needed to be?
So you'll always have like a director and a VP above you, right? So as an analyst and associate, you're not expected to have the same level of technical expertise, but you're expected to do the nitty-gritty work to begin with. So the VP and the director might flag some issues, and then let's say to use your example, it's a fiber network and they've looked to expand into a new area and it's not gone according to plan, right? And say our initial investment thesis said they would go and do that. I would then be responsible for looking at the financial impact on our returns as a result, right? That might be something I'm doing. Or I'm going to take the first look through the board packs and the board data to see, are there any just kind of like typos, errors? Are there any things where they're being a little bit misleading or not telling us the full story? As an analyst and associate, you're like the person who's expected to be the closest to numbers as possible. So you're meant to know all the like kind of key metrics like the back of your hand. And eventually over time, you'll start understanding how the business operations actually work and you'll develop that confidence. Does that make sense? The other part of asset management is, remember, we're taking money. If you're working in private equity, you're taking money from outside investors, and they want to know what's going on. So you've got to produce reports to them for each of the companies that you've invested into, telling them how much money has been deployed and how that investment is performing. So you not only give them commentary, but you also have to kind of actually run give them high-level financial analysis for them to be aware of as well. And eventually, as I said, you'll go and sell the company, and then you've got to work with the company to develop a sales narrative, kind of look through the company to see where the skeletons are hidden, right? Clean all of that up, and then start working with an investment bank, with advisors, to actually sell and market the company. They're very, very volatile. So there were literally some days I was out by 4 p.m., and there was other days I was out at 1 a.m., 2 a.m., right? So I think in general, you can expect broadly 8 to 9, like a 9 a.m. start, and then an 8 to 9 p.m. finish. If you're working on deals, that's going to blow up to midnight, 1 a.m., and weekend work as well. If you're just on asset management, you're looking closer to like maybe 7, like more on that 7 to 9 p.m. And then sometimes, because you've worked till 2 a.m. the day before, you'll finish at 4 p.m. the next day. Right? Does that make sense? So origination, asset management, let's say 8 to 9 p.m. If you get stuck on a deal, it's going to be pretty intense for most parts, but there will be down periods once you've submitted the deal where they'll kind of give you a little bit of slack. So I talked to you about what private equity responsibilities are like, right? This is about kind of how it feels to actually be a private equity analyst turned associate, right? So, and this is literally one-for-one maps to my experience as well. So as a first year, you're kind of really eased in because you're a bit of a baby, especially if you come out of undergraduate, you're not expected to know all that much. So they'll give you loads of like relatively easy tasks to do, like admin, high-level financial analysis, and they won't be kind of too critical of you in your first year. That massively boosts your confidence, and it feels like, oh, actually, I'm really good at this thing. Then second year, as a second-year analyst, once that hits, the expectation of you massively shifts upwards, because they're like, you've done a year at the firm now, you know all the key processes, now it's time to actually really ramp things up and give you significantly more responsibility, and also significantly more difficult tasks to be doing. So you get hit with those things and you have this realization that, dear God, there is so much more that I didn't realize goes into deals and goes into asset management that I didn't have a clue about. And do you remember I said that private equity is not the best place to learn technical skills? This is where they asked me, can you build a model from scratch? Can you run this quite complex piece of financial analysis? And I was absolutely stumped because I didn't know really how to do it. That meant that I wasn't on a deal at the time, so let's say I was finishing 9 a.m. to 9 p.m. I was getting into the office at 6 a.m., working on modeling completely by myself in an empty office from 6 to 9 a.m. before the day started. And then continuing on with the model from like 10 to 11 p.m. because that was the only kind of free time, quote unquote, I had on the day. And I did that for probably a period of 6 months, okay? So that's what it took for me to actually have the time to sit down and go through existing models and see how they were like built and play around and try and build them out for myself. You go through all of that, and that was kind of my Analyst 2 experience, and you come out the other side thinking, okay, this has absolutely destroyed me, but I feel like I kind of know my stuff. And as a third year, you'll make it to an associate, you'll feel a lot more comfortable with your place in the firm, you won't feel as much of an imposter, and when people ask you to run a piece of analysis, you won't be filled with dread, you'll be like, okay, I'm pretty sure I can give this a pretty good go. And so your confidence will boost up. I don't know what happens after associate because I only made it that far, but that was broadly what my first 3 years in industry looked like. Yeah.
Do you get weekends for free or
Most of the time, like so I only worked on like a really, really intense deal once I made it to associate. Like the other ones kind of died a bit earlier, tend to die kind of in the early stages because it was a recession. So for most instances, I did have my weekends off. Like I was probably like working a Saturday or a Sunday, maybe at most like once a month, but really not too bad. But then when I was on a deal in my final year there was like a period again of like 3-4 months where it was every weekend, and it was maybe 6, 7, 8 hours every weekend, like every day of every weekend. Trying to like submit like a paper or like run new financial analysis and stuff. It very much will depend on who your seniors are as well. Some seniors will be more pushy than others, and that will have an impact. But the best way is to just look at existing models that your bank has, like even the models that you're using for asset management, and actually take the time to see how they've been constructed, like what links into what, and how do all the formulas function? Because during the regular day, you have so many different tasks to do that you're just focusing on getting the work done. So you don't really necessarily have the spare time unless you actually make it proactively go and do it to actually really analyze the construction of a model. And so then you see, okay, like I can broadly see that a lot of the models follow the same sort of pattern. Or they follow this same sort of order, and therefore I get a good sense of how to build it going forward. Let me tell you about, I guess, for anything related to banking, so it can be private equity, it can be for investment banking, it can be for sales and trading. These are like my 2 cents on the recruiting process because they're, as an undergrad, broadly the same irrespective of what you're applying for. You probably already know the pathway, I'm guessing. So you do spring week in your first year, summer internship in second year, and then you just join as a grad once you've graduated, right? This is my take on each one. Spring week obviously is the easiest in principle to get access to because it's probably the point where you're most likely to be on a level playing field in relative terms. So, and it's obviously something that you can do multiple of, right? There are people who do like 3 or 4 spring weeks over the Easter break. So you've got multiple chances at this thing. But in terms of what to actually expect on a spring week, I obviously didn't get one, but I led them whilst I was at my old firm. And my 2 cents is that broadly, you're not actually going to get a huge deal of additional insight. It's more like a marketing campaign for the banks to show you the different divisions and why they're so good. I honestly think that the banks know that you might have like multiple, so they're just trying to convince you that their bank is the best. And again, realistically, most banks are pretty similar, if I'm being honest. So if you've got a spring week, my suggestion would just be to make the most of it from a networking perspective. Not only network with the people on the spring week, because they will become really valuable friends and good like kind of people to know as you progress through your career, but also network with people at the bank so you get a better true picture of what's going on. And so you'll probably have to network with those people at the bank outside of your regular spring week hours. And I'd say if you're going to apply for the spring weeks, just apply to, I mean, it's a numbers game anyway, so apply to as many as you can, but make sure you kind of apply to firms in different fields. Because the entire point is, I think the best thing about spring weeks is that you kind of get a little bit of a sense of the culture, or at least a bit of a better understanding of what actual work, what sort of work is being done. So spread the net out pretty wide so that you can then make an informed decision about what you want to focus your summer internship applications on. Is it banking? Is it asset management? Is it sales and trading? Is it hedge funds? Whatever, right? Then we move on to the summer internship. At that point, obviously, some people will have now had a spring week, so it becomes a little bit more difficult for you to access if you haven't already got a spring week. But I and many other people I know are living proof that it is still possible. But you have to kind of compensate for it, seek alternative pathways. I, for example, started doing work experience whilst I was in my first year in the second term because it became apparent I wasn't going to get any spring weeks, so that I could bolster my CV. I started working at a fintech startup. Some people go all out on like societies or volunteering or something, right? But you've got to do something to compensate and make yourself stand out. If you do land a summer internship, my biggest suggestion is banks have so many like training resources or models like that you can go and access to. And as I said, like sometimes the best way to learn how to do financial modeling is to just have a look at all the models that the company's working on and see how they're built up. So as much as you, yes, obviously focus on securing and the grad offer and focusing on your day-to-day tasks, try and find time to just make the most of the environment that you're now in. You're treated like you're an employee of the firm. You have access to the majority of the resources of that firm, so make the most of that. So go have a look at the models, even if you've not been staffed on them or you've not been given modeling work, so that you can then go and work on them or work on those skills or get a better understanding. Then finally, you've got grad entry. And at that point, if you haven't got a summer, it becomes exponentially more difficult to break into because that's kind of like almost like a default requirement. Again, not saying it's not possible, just very difficult. And so I would suggest that you consider alternative pathways, whether that's if you want to do investment banking, some people go into Big Four first and then they go into investment banking. Some people consider doing a master's, which then enables them to reapply to summer internships. Those are some of the most common strategies. Once you're on the grad role, I think it's super important to continuously reflect on what you have to be honest with yourself, because at this point you've worked so hard to get here that you can sometimes trick yourself into convincing, I guess, yourself that you're enjoying something when you're really not. And I've seen people do this and they end up sticking at the firm for way longer than they probably ought to have. So continuously reflect. If you think that the firm isn't properly prioritizing or helping you learn in the best way possible, be vocal. That is something that I made the mistake of. I got put on a deal where I was sold that it would be a really good deal experience, but I wasn't really learning anything, or I was learning suboptimally, and I wish I'd raised my hand and got allocated to a different thing earlier. And also just be open to other opportunities because they will come up. And I guess the earliest and easiest time to pivot industries or pivot companies is kind of when you're first establishing yourself in there. Because once you spend a few years, you run the risk of being labeled as like the infra guy or the investment banking guy, right? So then it becomes a lot more difficult for me to then pivot into, let's say, software private equity, or in the case of investment banking, to then pivot into sales and trading. So if opportunities do come up, and they will, just be open to them and open to exploring them. And then finally, my only other thing, I'll answer in just a second, right? The only other thing I'd say is that recognize that corporate care about the company first, HR care about the company first. They will prioritize themselves. And so it's super important for you to like, at that point, not just focus on your career or like not just tie yourself to the company. Think about alternative options, as I said, other opportunities, but also if things go, as I said, things can and sometimes will go wrong. So you need to come up with alternatives or backup plans upon backup plans. It's really crucial that you do that. Then these are my top tips for the application process. And the way I think of, like these are the main 5 stages, right? Or a typical 5-stage process. I think the first 3 stages, so your CV, cover letter, the general application, the hire view, and the online tests, I honestly think it's a bit of a numbers game / pot luck as to whether you get advanced to a phone interview. So just do as many as you possibly can, and then just focus on just nailing the fundamentals. As long as you're confident you've got the fundamentals right, like just be content with that. You're not going to get like a particularly good success rate up until the phone interview point, right? So when it comes to the CV, for example, is it 1 page? Is it well formatted? Is it tailored? And have you like focused on your impact? Like have you really presented yourself in the best light? Similarly with your hire view, are you using the right technique that all the firms are looking for? Have you prepped your stories in advance? All those sorts of things. Once you get to a phone interview, or once you get to a stage where you'll be interacting with an actual human being, in my head, that's the point where it's actually down to you and your skill level, and it's time for you to show off your understanding, your knowledge, your flair, and things like that. So for context, as I said, I applied to 30 places. I got 4 interviews and got 3 offers, right? And for those of you wondering, the one I missed out was final round McKinsey. So I think at that point, it's entirely down to you about your level of preparation, your research behind the firm, technicals, and things like that. So I think my point is don't be disheartened if you get rejected at stages 1 to 3. Once you get to stage 4, I think it's super critical that you really spend time, you kind of insanely fixate on how you can improve on all of the things that I've listed here to maximize your chances of securing. Does that make sense? That's kind of my advice to people. Focus on the fundamentals up until there, be happy, content with that, know that you're going to get a bunch of rejections. If you get to point 4, that's where the real game actually starts. I obviously got lucky and had a really random connection into a fintech. What if you don't do that? I used method 1, reaching out to friends and family and having to know. Second thing you can do is just approach businesses in your local area and see ones that have a vague connection to the world of finance, I guess. So that could be an accountancy firm, that could be property developers. Once you get those things, it's just about on your CV how you spin it to show the synergies between that and private equity, or between that and investment banking, for example. And then finally, you can reach out to startups who are looking for interns. You can find it on websites like LinkedIn. There's also a website called Wellfound, where they're literally it's a hiring platform for startups. Here's how I would the 2 methods I would use to come up with a cold call list. The first method is the LinkedIn method that I tell people. So on LinkedIn, you just go to the companies tab, and you set the following filters. So as I said, the majority of financial firms are going to be based in London, but you can also, I guess, try Birmingham, which is probably the second best for people in here. Set the industry to either investment banking, or I think it's called private equity and venture capital principles are the 2 that come up on LinkedIn. And then search terms, you either put, if it's investment banking experience you're looking for, put in advisory. If it's private equity experience that you're looking for, put in capital or management. The reason why is that most new startup or early stage investment banks and private equity firms all seem to have those terms in their name. So that will just yield you a bunch of results. And you can kind of do the same thing with Google Maps. Just hover over to the City of London or Canary Wharf and type in those search terms, and it'll pop up with a bunch of early stage companies. For people who are interested in the entrepreneurial side of things, I just thought it'd be cool to give a little bit of a timeline of what I've done since leaving, just to understand that firstly, your journey isn't going to be linear. And secondly, like things will take a lot more time to develop than you might have first thought. So I left, my last day was June 27th, 2025. My lease for London ended August the 17th. So I basically said, okay, this is a month and a half where for the past year, I basically haven't seen London during the day. Let me now spend a month and a half actually enjoying the city that I live in. So I lived my best life for about a month and a half. And in my free time, I started learning broadly new skills that I thought would broadly help with running a business. So email marketing, and I was going to be doing the marketing all myself, so learning how to actually edit videos and make better quality content. At this point, I didn't actually know what I wanted to do. I knew I wanted to do entrepreneurship, and I had a couple of ideas, but I hadn't like firmly decided on one. And also, I initially had an idea that I would work part-time somewhere and run a business. So I moved back home, well, I guess August the 18th, right? And for a period of about 2 months, I tried working on about 4 business ideas all at once. So I thought I wanted to work on, having worked in private equity, one of the main things was we were struggling to find experts for certain fields. And my dad just happened to know someone from like his schooling days who was running a recruitment agency out of India. So I considered like doing a potential like partnership or JV with them. And then I realized I wasn't really passionate enough about it. My girlfriend next year will be applying for like what deaneries for medicine as like a foundation 1 doctor. And there's like now a new random allocation of how students are allocated. So I looked online to see like what the probabilities of her landing a certain deanery would be based on her ranking of the deaneries. That didn't exist, so I tried to build it as an app. Couldn't get the data from NHS England, so that thing burnt, right? I thought that I would contribute to my family business. My dad runs like an engineering procurement company and he wanted me to get involved. I tried it, realized it wasn't really for me. And then my younger brother is autistic. There is a massive demand for autistic carers, and not necessarily enough supply, or people don't know where to do it. We as a family had experience, so we thought we could potentially run autism, like an autism caring supply company. Again, realized this wasn't the thing that I wanted to be spending 12 to 14 hours. As much as I love my brother, this was not a problem. This was not the pain point or problem that I wanted to dedicate my life towards. So again, I quickly stopped that. But in the space of like a month and a half, I tried all of these different things. And it was only at the end that I realized that, okay, the thing that I'm still the most passionate about is ASURE. And I'll get to you about that. It took me a little while to come to that realization, but then I started moving. Like I started a strategic partnership with a company called Chat University, you might have heard of, especially some of the first years in here. I refined like what exactly it is that I wanted to achieve, what's the roadmap, and then from the start of this year, I've actually been going on executing it with the help of some of the people actually in this room. All of this, as I said, is just to point out that your progress won't be linear and you'll probably have a million ideas. Just, in my opinion, just go for it. I think it ultimately depends on your risk appetite. I think everything that you just said, so whether to go into industry first or not, just depends on like your level of risk and what you think works for you. So for me, I was kind of relatively risk averse. So I thought, let me first get finance experience. I think it would be a great learning opportunity. You get all the resources of a massive company behind you. So working in finance, you'll also earn a lot of money in a relatively short period of time, which meant I could invest into things to like pay me money that I can use to get me by whilst I'm not like consistently earning. And it gives you that like layer of security and safety, right? Because ultimately, if you've got those skills, if you've worked in finance for 3 years, I'm fairly confident that I should be able to come back into the industry if I so needed to. But also, as I say, you've got the financial resources behind you to actually either invest in your business ideas and confidently do so and take those additional risks, or to make like kind of sound investments that will mitigate your downside or hedge your downside. So I, for example, invested in a property before I left my before I left my job that's paying me rent every month. Just use some of my private equity skills to secure a good deal. So that is paying me, you know, a good enough amount of money to bide me over, or at least cover my day-to-day expenses. So as I mentioned, I'm obviously very entrepreneurial, I like to think I'm very entrepreneurial, but I'm very early in my entrepreneurial career. So maybe these things will change, but based on my kind of 6-7 months having taken on doing entrepreneurship, I guess, full time, these are the biggest things that I wish I'd known when I was starting out and that you guys, I think, can apply today. Which is, I think broadly, university is the best time to actually start preparing or practicing the skills that you require for entrepreneurship, which is why I'm really glad to hear that I think Warwick's really pushing for this right now. It's a great time for you to join startups, to be part of entrepreneurship society, attend events. As a student, you basically get a free pass in a lot of cases to shadow businesses that you don't necessarily do once you've left university. Also, in relative terms, now is the time in your life where you probably have the most free time than you ever will have or ever have had, because outside of your lectures, there's no constraints on you. So you can use that time to brainstorm ideas, have a go at building ideas. In a world where of vibe coding, never has it been easier for you to build, early stage scrappy prototypes, MVPs, what we call minimum viable products, proof of concept, whatever you want to call it. The one thing I wish I had done, as good as AI is, and I'm sure we'll see progresses in this, is to get somewhat more technical. I guess I got technical in the world of finance. I can build a financial model pretty easily now, and I can tell you most things about the world of private equity. But as someone who's trying to build an education tech business now, I wish I'd learned some of the software technical sides of things, because increasingly that is something that is becoming necessary as we become more tech dependent and we move into a digital economy. And in fact, if you look at a lot of venture capital companies, so these are companies that basically back and provide money to early stage founders or early stage companies, a lot of them as a minimum requirement are now only looking to support what they call technical founders. So people who have who have the technical ability to actually create the product themselves. That, or they have either that, or you have a non-technical founder with a really good technical director behind them, or development teams backing them. So if there was one thing, even if you hate coding and you hate the idea of programming, I think it's just one of these skills that if you do think entrepreneurship could at all be for you, just go and learn it. There's more resources now than ever to go and do it. And honestly, me having made that mistake, I'm kind of suffering for it now. So that's just my 2 cents. Make mistakes, make plenty of mistakes, and just learn from them. As I said, you've got plenty of time, and you've got plenty of time to kind of rectify and start over and course correct. So as long as the mistakes that you make don't have a huge financial impact, don't be afraid to make them, right? Once you actually start a business, the main thing I found is that prioritize what really matters and constantly evaluate and ask yourself and question yourself, are you doing the things that will drive the most value? Unlike school, unlike even university, and unlike even in your career, there is quite literally no one that is going to hold you accountable. You are going to take sole direction in most cases for what your company is going to do, what your business is going to do, and what are the next steps, right? And it's so easy to either procrastinate or to do the things that you find most enjoyable, but don't necessarily add the most value. So as an example, as I mentioned earlier, I spent July learning how to edit and learning how to do email marketing, only for me to then kind of eventually question, I don't think I'd achieved a decent level of editing and knowing how to edit. I don't think knowing how to go really technical in editing is really going to have that much of an impact on the success of my business. Similarly, learning how email marketing automations all work is all well and good, but first I actually need a product, and I need to refine that product and develop something that people actually derive value from. If you have an idea, don't try and get it perfect the first time, because you'll spend loads of time on this before even validating with the market, with your customer base, whether they actually like it or not. And as I said before, now with the use of AI, it's so easy for you to build high-level scrappy things, test it out. You can still even monetize it at that stage, and see if people actually bite. If they do, then you can go and refine it and make it better and address any issues. But start off scrappy, start off manual. And as I mentioned before, progress won't be linear, nor will it be immediate. And that takes you something to get, it's something that you do have to get used to. You work in corporate job, you're getting used to putting in loads of hard work and being guaranteed a paycheck at the end of each month. You'll probably work even harder or you almost definitely, if you want to succeed, work even harder to build a startup. And you're not guaranteed that paycheck. And you need to get comfortable knowing that effectively you're just investing time and resource and that eventually it will pay off. But again, it's super critical to continuously evaluate and hold yourself accountable and honest as to whether the market is validating your product. It's so easy to say, oh, people just don't understand, people don't quite get it. The market and the customers are always right in that sense, so really take it on board. Okay, so now if I have just a little bit of time to explain what ASURE actually is. So as I mentioned, because I didn't get any spring weeks, I became super passionate about helping other people and making sure that they didn't make the same mistakes I did. And generally, initially I was just helping people in my third year of university, spending hours on call with people, walking them through every part of the application. I realized that this wasn't going to be scalable once I actually hit the world of work. So the first thing I did was just build a YouTube channel. Some of you might have seen it, where I gave the advice there in a video form so that it was easily scalable in that sense. From there, it grew and people actually reached out to me, wanted coaching, wanted consulting, and some people were still in school, so they first needed to actually get the grades to go to a top university like Warwick to maximize the chances of breaking into finance eventually, right? But my thesis or key observation is this. Many students, some of you, you will have experienced this, do not make mistakes that make it more difficult for you to break into your dream careers, not because you're not talented enough, but just because you don't have the right information at the right time. Had some of you known maybe that a CV needed to be one page, or just how competitive spring weeks were, or just how early the application process started, some of you who haven't got spring weeks today might have had them, right? So in the world of economics, this is a market failure that I wanted to resolve and address. And I think another thing is broadly that people don't actually or fail to realize just how early your career actually begins. The decisions that you make at school, even though they can sort of seem inconsequential at the time, can compound into having massive effects on your employability in the long run. And I think that in the British education system in general, careers at the school level and even at university, isn't fully or properly addressed and given the attention that it deserves. And now, because there's so much information out there, it's even more difficult because there are so many different routes. There are so many conflicting opinions. So I want to try build one kind of uniform sole point or source of truth for students, whether they're at school or whether at university, to help you navigate through that early careers journey. Now, of course, if you're at school, that probably comes with maximizing your grades. That's going to open up the most doors for you. People at Warwick, you know this, right? But once you're at university, it's teaching you the skills, or making sure that you already come into university with the skills that you need to hit the ground running in terms of applications, so that it is well and truly a level playing field. So it's actually the people with the top talent getting in, rather than people not getting in because they suffer from asymmetric information or information barriers. And these are just some examples of things that people at the point from GCSE to university suffer with or have to nail or get right. And some of the stuff that you guys now at university have to make sure you get right every time you're applying to a job. But also, you start thinking about what are your options after university. If you do investment banking, are you going to do into private equity? Are you going to go into venture capital? Are you going to go into a hedge fund? And again, that's not necessarily always properly addressed. So that's the one thing that ASURE as a platform is looking to build. So how can you guys get involved? You can both, I can, and we, I guess as the ASURE team, can help you, but you can also help us, and I guess in a way that you might not have expected. First is just to help us get the name out there. So to do that, you can follow the ASURE brand on YouTube, on TikTok, on LinkedIn, as you'll get a bunch of insights from me. If you found this talk useful, I deliver even more things on my social media that I haven't covered here. As I mentioned, I think the track to get people into achieve their top or true potential and not fail due to market failures is to address and rectify them at the school stage. So if you know any people, young students, if you know parents or family friends within your network who think they might need academic tutoring to get the best grades or looking for some guidance on careers, university, then you can just visit the website or you can ask them to email me. And then finally, you guys have made it to Warwick, one of the best universities in the UK. There are people out there who are dying to learn from your expertise, your subject knowledge, but also the university process. So if you want to join part of our tutoring team, of course it's a paid position, you can drop an email again there, or you can just message me on LinkedIn, whichever you prefer. And how can we help you? Ultimately, I want to make this super accessible, and I will be building out resources and tools for all of these things. But in the meantime, you want to work with me, you want to benefit from all of my expertise on a one-to-one basis. If you need any help with any of these, you can head to the website or you can mail me or message me, whichever works. I think that's the end of my presentation.
Yeah.
Anyone?
Before we start the Q&A, I think we should all just give another round of applause for Arabic.